All right, so welcome everyone. We are now recording. Welcome to the session with the guests Darryl and Tia. I'm very excited to hear from you. I have heard Darryl and Tia speak at a number of different presentations, and I really love hearing you guys speaking. I love how you make financial terms very easy to understand. So I'm looking forward to this session. Before we get started, I do want to acknowledge that I'm calling in from the lands of the Coast Salish peoples, including the Musqueam, Squamish, and Tsleil-Waututh nations, Vancouver, BC. I'm going to share a little bit about myself. If you're not familiar with who I am, my name is Julia Fauci. I'm a business coach. I'm a holistic business coach, and I'll explain a little bit what that means. My experience in the corporate world is mostly in digital marketing. I worked for over 12 years as a digital marketer in corporate, have worked with B2C, B2B, and tech companies, have worked with Profit 500 recipient, that's a winner of fastest growing companies in Canada. Also served as director of digital marketing at a big agency, web development agency here in Vancouver. And then I moved into tech as a marketing growth manager. And after those 12 years, I wasn't feeling as excited about executing all that marketing stuff anymore. And I started to think how I wanted to serve my skills, and because I still love marketing and strategy, but how I could make this in a different way. With that, I started business coaching towards the end of 2019, helping especially women in the early stages of their business, those first 3 years, kind of building a foundation for the business. And as that evolved, I started also seeing the need to provide better kind of emotional support to run the roller coaster that is to run a business. We know we have lots of ups and downs. It's not all about marketing and strategy. So with that, I got my mindset coaching certification. So I work a lot with mindset. I'm certified in NLP, neuro linguistics programming, and EFT tapping as well. So I kind of bridge that marketing and business side with the emotional support as well. So that's what I do in a nutshell. And with that, I'm going to introduce Darryl and Tia, who are here with us today. So they are from Wealth Blueprint Strategies. And today they're going to be talking about how to build your own pension plan as a business owner. So Darryl and Tia are a husband and wife financial advisor team. Sorry, just letting people in because people are still coming and I'm managing all things at the same time. Darryl, feel free if you see people coming in, you can let them in as well. So Darryl and Tia, they're a husband and wife team. Their passion is to educate others on how to make their money work better for them. So they are experts in cash flow planning, life insurance, investments, and retirement planning. And their commitment to their clients has gotten them recognized for being the top 5% of financial advisors in the world. Wow. That's amazing. It's like, give me goosebumps, 5% in the world. So let's get ready to learn what are some ways as a business owner that you can grow your money. So off to you, Darryl and Tia. Thank you for being here.
Excellent. Thanks, Julia, for bringing this together. Good afternoon, everyone. I'm Darryl Ho. This is my wife and business partner, Tia.
Hi, everyone. So hope your day is off to a great start. Thanks for sharing your lunch hour with us. So our goal today is hopefully that you'll be able to learn something new. We're just going to share our slide deck and make sure that everybody can see it before we start. Can someone give us a thumbs up to let us know that you could see that okay? All right. Yeah. So today's seminar, we'll be talking about how to build your own pension plan for business owners. So there are many great things about being self-employed, but what we don't have is a nice, cushy company pension plan to rely on when we retire. So we're just counting on what's inside our company's account. To make sure we're growing that money properly for retirement, let's look at some different options.
Great. Just give me 1 second. I'm just going to move some windows around. Okay, here's what we'll be covering today. So first off, we're going to tell you a little bit about us with our story and why we love what we do. Then we're going to be answering a question which is asked by many to accountants and lawyers. When should I incorporate? Our answer is simple and logical. Then we're going to talk about the flow of money inside your corporation and how taxes work. And then after that, we're going to go over a traditional way on how to invest your money and how to build your own pension plan will be a smarter way. So at the end, we're going to have lots of time for questions, and we're going to draw the $50 Amazon gift card for all those that registered. And for all those that stay till the end, there's going to be a $100 restaurant gift card for you, because it's kind of like a lunch and learn. We're not in person, but we're going to raffle off $100 for whoever stays to the end. If you have any questions during our session, definitely post it in the chat, and Julia, you can help us manage it as we go. Okay, let's get started. Yeah.
So just so we can know each other a little bit better, here's a few things about us. So this is the most recent picture of our family, taken just this last Sunday on Mother's Day, on my favorite day. There's a picture of Darryl and me, and our oldest son is Ethan, and he's 16. Welcome, JC, that just joined. Sorry. So yeah, he's 16, and he just got his learner's license from last month, and Darryl is already taking him on the city streets and highways. It's like a next level of worriness, but that's what's gonna happen. Madeline, she's the baby of the family, and she's 14. She plays competitive basketball, and these days we are just chauffeuring her to and from practice and games pretty much almost every day. So I can't wait till her brother takes over that duty. So maybe in a year. After 2 kids, we moved on to fur babies. We have our 2 dogs here. The white one is Bentley. He's our Maltese. And the little one, Peanut, he's the toy poodle. So they make our house very loud and very lively.
Might hear them in the background later on.
Yeah, let's go back, like way back to 1994. The black and white picture on the top left, that's when Darryl and I started dating. So we were 15 years old, and we've been together for 29 years.
30 will be next year.
30. Oh my goodness. And then after high school, we went straight to UBC. Darryl graduated as an engineer and I as a teacher. So not our respective fields, but that's why Darryl calls himself a financial engineer and I call myself a financial educator. So the same. And after we graduated, we wanted to get married, but we had a huge student loan. So Darryl owed about like $40,000 worth of student loan, and I owed about $20,000. And that's when really our kind of financial journey began. So we had to come up with a financial plan to get out of debt, save it for our wedding, and then eventually a home. And then fast forward a few years, we were able to save enough to get married. We bought a first 2-bedroom condo in Vancouver for $143,000. So even then we're like, oh, should we do this? Should we not? It's a lot of money. When we sold it in a couple of years, we made about $60,000. And we used this profit to put as a down payment for a house in the North Burnaby area. So this sounds like a nice typical upgrade, but what we realized afterwards was by selling the condo instead of keeping it, we missed out on all the future potential gains. So of course that condo today is worth like over $700,000. So in a way, we missed out on like $500,000 that we could be in our pocket today. So we learned quickly from that mistake. So for the next rental condo we bought, instead of selling one property to get another property, we used the equity of that house. Then when the condo prices went up, we used the equity of the condo and the house together to buy another house. So that's really how we kind of accelerated our net worth 15 years ago. Just using the power of equity was something that they never taught us at school. And to this day, like, I don't think that is taught at school. So by leveraging real estate, we were able to use the gains or the equity without having to sell it. And now we can benefit from the homes still appreciating in value at full market price. And we learned that we can do this with through real estate. And the second thing is through actually life insurance. So back then, you know what, we wish someone could have guided us and let us know all the different options that were out there. And really, this is how Wealth Blueprint Strategies was created. So that's why we're so passionate about educating others, because we know how it feels to not know of all the options and then finding about it later when it's too late. On the right are just some pictures of us tearing down one of our properties and building our dream home. We use equity from our properties and actually all the life insurance policies to fund the build. I think we had like 13 policies back then.
I think 13. I think we're about 17 now, but about 13 back then.
And later on, you'll see why we have so many insurance policies. And the house just complete just before COVID. So you know what? We still haven't had a formal housewarming party yet. So we're excited to be able to invite lots of people over when that happens. Hopefully,
I think maybe next year. We'll
Next
be celebrating a 5-year anniversary in the house, 30-year dating anniversary.
go.
It'll be a good excuse to
That'll be
get everybody
perfect.
over. So everybody, if you take a step back, you'll see we came from a negative net worth after graduating from UBC, to buying our first home, building a real estate portfolio, growing investments, and then building a dream house. So regardless of where you are financially, we've been there and we know what to do and what not to do. When we built a company, Wealth Blueprint Strategies, we wanted to stand out amongst other advisors. And so in addition to being a husband and wife financial advisor team, the next couple of slides highlights a few other things. It's going to add a few more people in. So for us, we are licensed in British Columbia, and thanks to technology like Zoom, electronic applications, e-signature processes, we can also help Canadians in Alberta and Ontario as well too. So slowly moving across Canada.
There, sorry, just so you know, don't worry about people coming in because I'll manage now. It was just when I was speaking, so I'll take care. Don't worry.
Awesome. Okay, good.
Thanks, Julia.
Wealth Blueprint Strategies, we are independent advisors. So what this means is we don't just offer solutions from Sun Life or Canada Life or Manulife. Here are some of the companies we have access to. So there's probably about a dozen or so there. So we always have your best interests in mind. So you can count on us to pick and choose the best financial institution that specializes in the solution we're implementing for you.
And for us, we choose not to be fee-based advisors. So hopefully you can see from our story that, we're doing okay financially. Rather than charging a few thousands, dollars here and there for a financial plan, what's more important to us is earning your business and having a lifetime relationship, and you referring us to others so we can spread our knowledge, I guess. And all financial advisors, like how do we get paid, right? We get compensated whenever we place a solution with one of the companies that Darryl mentioned. Since we already get compensated, we feel like we don't need to double dip and charge a management fee or a servicing fee on top of that. So therefore, with us, you have 100% of your money working for you at all times. And there are thousands of financial advisors in Canada, aside from being a husband and wife team, not charging, not being a fee base. We kind of have to know our stuff, right?
So this kind of leads us to the next slide. Here are some of the designations that sets me apart from the rest. First, I'm a CFP, so formerly a certified financial planner, and I also have the next level designation after that, which is Chartered Life Underwriter, or CLU for short. As a CLU, what I specialize in is advanced tax planning, advanced estate planning, and corporate financial planning, all the exciting stuff. On the bottom, it says Infinite Banking Concepts Authorized Practitioner, or IBC for short. This is a certification on how to structure life insurance so it could be used as a bank account. That's why we specialize in that. In all of BC, there's only about 8 advisors who have this certification, and I'm one of them. On the top right, MDRT stands for $1 Million Round Table. And last year, we actually achieved quarter of the table. And that's pretty cool because that recognizes the top 5% advisors around the world. Pretty cool amongst those that achieve that globally. And then one last license I have is my mortgage license with Dominion Lending Centers. I had my license since 2011. So if you have any mortgage planning questions, I can help with that as well.
The long story short, really, Darryl is a financial guru. Okay.
I guess that sounds about right. Okay, so next on our agenda is answering one of the most common questions from entrepreneurs is, when should I incorporate? Like most business owners, majority probably start off as a sole proprietor. So when should you incorporate? And then depending on who you ask, whether it's another financial advisor, an accountant or lawyer, you're likely going to get a bunch of different responses. They're probably going to say, it depends. And you might still be confused afterwards. What we want to do is give you our perspective to keep things simple. So from 80% of you, so the majority of you, it comes down to 2 things. So number 1 is if you earn more income than you need for personal expenses, you incorporate. Pretty simple. So for example, let's say you need $100,000 for personal expenses. If you start making 120K or more, then you incorporate. And then number 2, if you want to separate your personal and business assets for liability purposes. So if you're in a profession where you're at risk of being sued and you do not want to impact your personal assets, then you incorporate. So that's it. Simple, right? For 80% of you, if one of these two reasons apply, go see a lawyer and get incorporated. If you're still not sure, or if there are other reasons, then you're probably not the 80% majority. So come book a time with me, your accountant or your lawyer, and then we'll do more of a detailed assessment.
Darryl, sorry, can I just say the number one tip you put here? I wish I heard this sooner, because I always see people, I've spoke to many accountants just in the line of work that I do. I do a lot of webinars and I always bring different accountants and I talk to different accountants, and I always hear some numbers, like it can be 60K, 70K, 80K, like it varies, like, and they all say there is no cut, like there's not a definite cut, but just like roughly around that. But actually, the real answer is actually what you put in there. It depends on how much you spend in your life. So if you can live out of 40K a month, then yeah, 60K is great. But if you're spending 60K in life expenses, then it doesn't make sense anymore. So I love that you put that. And honestly, it is the first time I'm seeing someone sharing this way and not giving just rough numbers. So amazing. Thank you.
Good. Thanks for that. Yes, we want to try to keep things simple. That makes sense, right? It's all so for me, it's just all logic. Comes down, yeah. When it comes to incorporating, right, one of the key benefits of incorporating is those lower taxes. So here's a bit of a tax lesson: is in BC, the first $500,000 you net, so that's after expenses, that's only taxed at 11%. So if you earn $500,000, and let's say that example, you only need $100,000 for personal expenses, right? Out of that $500,000, you pull out the $100,000 personally, you pay tax on that $100,000, but that $400,000 stays inside your company and is taxed at 11%. If you're a sole proprietor and you earn this $500,000, all of that gets taxed, and that puts you into the top 53.50% tax bracket in BC. So that means you lose more than half of your money going to taxes. So definitely you want to incorporate. Less taxes that you pay in the corporation means you have more dollars to grow your business, right? Invest in your business, etc. And then since you control how much you pay yourself, that means you're the one in control of your personal taxes, not the government.
Yeah, so a good example for us was last year in 2022, we sold our North Burnaby rental house. So of course we had huge capital gains to pay, and just the capital gains alone put us, of course, in the top tax bracket, 53.50%. So if we paid ourselves any money from Wealth Blueprint, right, we would lose actually more than half to taxes. So for example, if we usually pull out $100,000 each as a salary, that's a total of $200,000, we would have to pay over $100,000 in taxes. But since we are incorporated and we control our own personal taxes, we end up paying ourselves $0 last year as a salary, and just kept all the money inside our company and let it be taxed at 11%, which is a lot better than the 53.5%. So by doing this saved us over $80,000 in taxes last year. So whew, that's a pretty good savings.
Hey, I got a question for you. So if we didn't pay ourselves $100,000 each and paid ourselves zero, what do you do with that extra surplus savings in our company?
That's a very good question, Darryl. So this takes us to the next topic in the agenda, which is, what do we do with the extra money in our company now, right? So, you're saving money, your company dollars are growing. What should we do? You put in the stock market. So let's talk about the traditional ways to invest your money. Most people only know of investing in stocks and mutual funds, right? It's like, I've got money, what do? Put it in mutual funds. However, going this traditional route has potential problems. One of the problems is the stock market can go up, but of course it can also come down, right? So we've seen this in 2022 during COVID, during 2018, 2015, 2008, etc. So if you were retiring in any one of those years, your retirement fund that you've been saving over the years would have taken a hit. And there are times when we need to pull the money out, out of our investments to either buy more office equipment, to buy a company car, or buy an office space. But each time you take the money out of the stocks and mutual funds, you stop the compound growth. And that will also impact your retirement fund in the future. And then when you do retire and you start withdrawing the money from your stocks and mutual funds, you keep depleting it until with each withdrawal, and then your account gets lower and lower and lower. So, eventually when you pass away, only whatever that's left over minus the taxes will go to your loved ones. So each dollar that you take out is $1 less for your loved ones. So is there another asset that you can contribute your corporate dollars to? The answer is yes. Really, the solution is build your own pension plan using actually life insurance.
And again, we're not talking about any type of life insurance, right? It's not term insurance. It's not universal life insurance. It's actually designed using participating whole life insurance. So what's this type of life insurance all about, and how does it work inside a corporation? For the next, what we want to do is we want to share with you how money flows inside your company and how it's taxed.
Darryl and Tia, sorry to interrupt. Before we get there, can we clarify something that Victoria asked? And I actually had the same question, but if you paid yourself $0 in salary, as you were saying, how did you pay your bills? Like, did you take dividends, or did you use the life insurance itself? Did you use the life insurance itself?
For that particular year, because we sold our house, we had and it was personally owned house, we had an injection of cash from the proceeds of house sale. So that was more than enough. Like, technically, we don't need to pay ourselves for the next couple of years because we made quite a bit of money on that house sale.
Got it. Okay. Thank you. I think that answers the question. But Victoria, if you have a follow-up question, feel free to jump in.
Yeah, definitely. Yeah, I'm seeing the bubble, but I don't see the questions pop up. So definitely, any questions, jump in, and Julia, feel free to stop us anytime. And so now we're going to talk about the flow of money inside your corporation, in your company, and how it's taxed. So you see a box here, that's your company. We're going to try to keep things simple, right? You have income coming in, and then you pay yourselves a T4, expenses that go out. Pretty straightforward. Money in, money goes out. And then at the end of the day, whatever you net, that is taxed at 11%, and then that money goes into your retained earnings. So this bucket here is kind of sitting there, and what most people do is you hold it as cash, right? People always have like a cash account just to make sure you have be able to pay expenses coming up. If you end up having surplus cash, what people do is if they need to draw out extra money, they take it out as a T5 or a dividend. And on average, when you draw dividends out of your company, it's roughly about 30%. So every time you have this bucket of money, it's not taxed, right? And every time you pull money out, you kind of deplete it, right? Worst case scenario is if you pass away and your loved ones winds up your corporation, all that money actually flows out of this box. And when that money flows out of this box, you pretty much tax at max because all that money just comes out all of a sudden instead of you dripping it out as dividends. So that's kind of worst case scenario in case happens. Whatever you saved up right now may look good, but when you pull it out personally, that's not actually how much it's worth after taxes. But before you pass away, another option is, like Tia said, that you can invest your money. But inside your corporation, when you invest your money, there's something called passive income tax. So the government actually takes just over half of what you earn. And the reason why is because, with the government, the first half earn you make, you get taxed at 11%. You're taxed low because what the government wants is you to invest in your business, grow the Canadian economy, use those savings to be able to hire more people and grow the Canadian economy, right? Some people, when they pay less taxes, what the government doesn't want is to pay less taxes so you have more dollars to invest for yourself personally. That's not the point of it. It's not to save taxes to grow. So whenever you invest in your company, the government's going to take a big chunk of it because they want you to actually invest it and hire more people, or pull it out, pay the government, and then invest afterwards. So
they want taxes anyway.
Yes. So if you think about it again, all this money in your retained earnings is in a taxable bucket. And every time you pull it out, regardless of what you do, if you don't have a plan in place, it all gets taxed. So the solution, instead of holding it into your bank account as cash, you want to start redirecting it and putting a corporate whole life insurance policy in your corporation instead. And with life insurance, it's actually tax-free. So the money can actually grow tax sheltered inside your corporation. And now let's talk about the end state, right? You have a life insurance policy, and how life insurance policy works inside a company is when you pass away, right? Unlike your cash share, when you pass away, it flows out and all gets taxed. With life insurance inside a corporation, upon death, your money actually flows out through this back door. Hopefully you can see that. It's a CDA, and CDA stands for Capital Dividend Account. So majority of a death benefit that happens when you have a corporate-owned life insurance policy, majority of that death benefit actually flows out through the CDA, and the CDA is actually a tax-free dividend. So your loved ones can actually elect that and pull all that money out tax-free, which is great because again, if you don't have life insurance, every single dollar upon death is going to get taxed when you pull it out. But with life insurance, it flows through something called the CDA or capital dividend account. So that's end state. But again, what happens during a lifetime, right? During a lifetime, what you can do is this insurance policy, it's actually considered an asset in the corporation. So it's worth something. So what you can do is you can actually take this policy to the bank during your retirement years and take something called a collateral loan.
That's a bank, by the way.
Yeah, bank, you can do it.
Looks like a wishing well.
Next time she can do the drawing. So you take the policy because it's worth something, you get something called a collateral loan, and that becomes your retirement fund. And that's how that works. And the beauty of this is that you can start drawing out an income from your insurance policy, but because you're using the policy as collateral, you're not actually selling it. So that policy actually stays intact and continues to compound and grow as you never took money out. So kind of keep that in mind. So therefore, the CDA room will still continue to grow. So not only are you able to draw out some of this money as part of your retirement fund, your loved ones will also benefit from it when you pass on as well, because the policy continues to grow as you take money out. So there you have it, like a one-pager diagram on how money flows inside your company and how taxes work. Now that there's a better understanding, let's compare investing traditionally inside your company versus moving your money over to a corporate whole life insurance policy, and then see which one stands out.
As we are here, I think this is a good spot just to ask if anyone has any questions, and you are welcome to unmute yourself if you want to ask any questions before we move forward. I don't see anything on the chat, but just want to give people the opportunity.
I think Victoria has a question.
Okay.
I always have a question, but I wanted to see if anyone else did. So this is really interesting, and I'm really thankful that I recently finished reading Robert Kiyosaki's Rich Dad Poor Dad for the first time, so that I can actually understand how taxes flow through a company. I don't, do other financial advisors talk about life insurance as a way, like this just seems like something I've never heard of before, and I'm like, why isn't this more common knowledge? How did you guys discover this? And like, yeah, is this what a lot of big companies do, like, and CEOs to sort of grow their wealth for generations? I guess a lot of questions.
Yeah, definitely this is something that we do for our own family. So we actually didn't discover this life insurance piece until we when we sold our property. And just like the story said, when we sold the property, we killed the compound growth, and we're like, oh, well, now what? So the life insurance works just almost like real estate, right? It grows, but even if you take money out of it, it still continues to grow. And then when we put two and two together, we're like, oh my gosh, like it makes sense, right? So of course, for any strategies, we always do it ourselves, right? So we have like 17 policies in place now, and we've been using it to fund to buying a car, purchasing our house, building our house. So we definitely been using it, and it's out there. Maybe
yeah, actually, like for me, because of my licensing, having the CFP and CLU, I need to double the CU credits that like a typical just basic advisor has. So I take a lot of these courses. I love this stuff, all this advanced tax planning. So if you were to go to any seminars, talk to any lawyers and accountants, everybody knows about life insurance. They might understand like term insurance, but anybody that's looking for succession planning or estate planning, almost 100% of the time, life insurance is part of the solution, because at the end of the day, someone's going to either sell the company or wind up the company. So there's going to be this huge tax liability, or it could be a realtor that has a bunch of, has a holding company with a bunch of real estate properties, right? So at some point, every 4 condos they sell, 1 out of 4 actually goes to CRA if you do the math and capital gains. So because you already know there's an end state, I got to pay, $2 million in terminal taxes. Well, how do you solve that with life insurance? Because there's no other asset you can have that pays you out such a large amount of capital dividend account into it. So it is well known. I don't know if it depends on the advisor, what they want to do. As you can tell, like it takes a webinar, probably 1 or 2 meetings to be able to explain how whole life insurance works. It's not a quote unquote quick sale. For us, we're the type of advisors where we actually spend the time to get to know you better first before we talk about solutions and see if it fits. There may be other advisors that just want to sell like on the first meeting, That's not us. So for us, we really want to kind of dissect everything and really have a full understanding of it. Implement it ourselves first, just to make sure, does this really work before we roll out to market? So we're usually a little bit slower compared to other advisors because we want to make sure we dissect everything in. And for me, being the engineer and the numbers guy, like for me as an engineer, I like to take everything apart. What are all the different rules and how do I put it back together more efficiently by keeping within the rules? So there are different ways to do life insurance just for purely estate planning. There are ones where you put money in and you really don't get to do anything till 20 years later. But again, that's not as fun. We're able to structure a policy differently, which is out there because life insurance has been around for a couple hundred years. It's just learning a different way to structure it. So when we put the money in, we can actually use it within the first year, like that fast.
Can
like
you tell that Darryl is talking about this?
usually
Yeah, no, it's okay. It's very interesting. I had no idea. I didn't I don't have a lot of awareness of life insurance. Like I didn't understand it could be used as a tool to protect and grow wealth and reduce taxation. So this is all very interesting. But it looks like other people have some questions too. So I'm going to mute. Thanks, guys.
Yeah, there is a question on the chat, JC asking, isn't it whole life insurance very costly, especially when older?
Awesome. If you start off later on, like for us, we're in the mid 40s. We ended up purchasing a policy just last year in. So I would say anybody up to about 60 to 65, it's worth looking at because you're able to put the money in and use it as well. If you buy other types of life insurance like universal life or non-participating life insurance, the cost may be a little bit lower, but then that money is being locked up. So the way that we structure it is maybe it could maybe perceived as a little bit more upfront, but because you can access almost 75% of it, it's a net out of pocket in terms of what's liquid and accessible. It's actually not costly at all.
Actually,
but yes, sorry.
I think that your next part of the presentation, when you go by age and you show how you can take money away and all of that, I think it's going to help to answer this as well. So maybe if you want to move forward on that.
Well, that question is like, yeah, if you're in your 70s or 80s, like you may not even qualify for life insurance. So then the older you get to start, it does cost more. But with these type of life insurance we're talking about, whatever age that you get approved at, you actually lock in that price for life. So it does not get more expensive as you get older.
And really, it just depends. We just run the numbers, right? So if the numbers make sense, then go for it. If the numbers don't make sense, then definitely we'll find another solution for you. Yeah. So we're going to move on next to an example, and maybe that might kind of help clarify some of the numbers piece. So we're going to look at an example where someone would invest in mutual funds with a 6% return, right? So that's typical, right? Versus building your own pension plan with a life insurance policy with Wealth Blueprint. So let's meet Sarah. She's 40 years old. She wants to set up a retirement fund. Her business is growing and her retained earnings in the company continues to increase year over year. So she's really starting to think, okay, I want to, retire at 65, and she wants to set aside $50,000 per year to put away for her retirement until she's 65. So that's about 25 years. And at 65, when she does retire, that's when she wants to start taking money out. She wants to withdraw about $100,000 every year until she's 85, to about 85, right? So let's assume that her life expectancy, she lives to life expectancy to about 86. So she's thinking of two options. Either one, she can invest with us in stocks and mutual funds, because again, we're portfolio managers. We can help you do that as well. And we'll try to aim for at least a 6% average return. Or she can do the build your own pension plan. So in the end, with either option, out of pocket, right, will be about 1.25 million, right? Because $50,000 times 25 years gives you about 1.2 that she's putting away. And then she would like to take a total of $2 million, right? Because $100,000 for about 20 years equals about $2 million she wants to take out during retirement. So let's look at the results. So here's a chart with her age on the bottom. So you can see that the age is on the bottom. The vertical axis, that's the money that her loved ones will get if she were to pass away. And that's after tax dollars. So then it's already been taxed. So this first line, this red line, is the mutual fund line, and it's growing at 6%. So each of those data points you see is what flows out of the company if she were to pass away. So let's take a little bit closer look. So after the first year, all right, Sarah contributes $50,000. I gain 6% in the stock market, but if she were to pass away at age 41, only for $34,505 would flow out. Just remember, like Darryl's drawing, the money inside that company is not worth that amount because it still needs to be taxed when you flow it out. So therefore, she only gets that a little bit over $34,000. The green line that just appeared on the screen is a dotted line we want to mark that's at 65 years old. So that's when she's going to stop contributing her $50,000 a year, and that's when she's going to start pulling out $100,000 per year for retirement. So let's look at the blue line. So let's look at the life insurance line. Look at the numbers there. So after the first year, that same $50,000 contribution will buy a life insurance policy that would actually pay out $1.3 million after taxes. Because remember, it flows out through that CDA room if she were to pass away. So if she passed away at 41 with life insurance, she would have a life insurance policy. It would flow out $1.3 million. If she didn't have one, that $50,000 becomes $34,000 that she would get. So it's a huge, huge difference. But of course, we don't want anyone to pass away, right? We want everyone to live a long life. We're going to fast forward to age 85. In both scenarios, she would have contributed the same amount, that 1.25. She would have enjoyed the same $2 million that she's been taking out for her retirement. But at 65, the life insurance option will actually give her loved ones about $80,000 $800,000 more money. So as you see the two lines, like, throughout her life, Sarah's life, you'll always get more with the build your own pension plan, with the life insurance plan.
So for our last slide coming up, we're going to summarize what we talked about in the table. But before we do that, we just come on and check in again with you, Julia. Are there any other questions since then?
Yes, there is a question. Can you do this personally as a sole proprietor and not a corporation?
Yeah, you can definitely do that. The numbers and the taxes might be a little bit different. But we can always start things off as sole proprietor. If you get to a capacity where you do incorporate, we just transfer the ownership, put it into the corporation afterwards. So definitely we can do that. And for us, we actually started off not incorporated, and we had actually personally owned policies. So out of the 17, I think 4 or 5 are in a company, but the other ones is on our kids, and we own those personally. So each one has different use.
Yeah, of course, with life insurance, the sooner you start, the price is lower, right? And the good thing is that price is level, which means you pay that same amount for your entire life. So Madeline, our baby of the family, we started her when she was age 0. So she got the best price possible at age 0. And she continues paying that premium for the rest of her life.
She does. We pay for it.
Well,
yeah. But we use it too. So.
So yeah, of course, if you start it sooner, it's always better. And then even though you're not incorporated, we can always transfer it into the corporation later on.
Perfect. And I guess I'm not sure if the next slide, that's what it is, but are you sharing about those withdrawals that you can take from this as an investment that you can still use? Because I think you shared that on another presentation that I watched, that it just shows like.
Yeah, we did. Yeah, our last presentation, we had a summarized. So all those numbers were summarized like in a bar, a table of the amount of money that you contribute, the money that you can take out, and how much the death benefit was. But we thought it might be too overwhelming with all the numbers, and we thought, okay, what's a different way to kind of show everyone? So we decided to do a line graph. But for sure, if that's something you're interested in, looking at the different numbers, like at each year, how much money can I take out? You can definitely book a meeting with us and we can show it to you.
Yeah, because a good point, like for this, and just before I get to Victoria, for this mutual fund line, the only way for it to kind of be forecasted to get through here is you got to put $50,000 away for 25 years. You have to make a 6% year-over-year return without any negatives. Like this is your average, but you can't touch any of this money. At any point, if you touch that money and you draw it out of your company, you deplete the growth and it can't grow anymore. So with the life insurance, we had, like another webinar, we can actually talk about what happens if you start taking some of the equity out. With life insurance, it's really like real estate, right? If you take the equity out, the policy actually continues to grow. You never sell it. But with mutual funds, stocks, any traditional investments, every time you take your money out, you have to sell. So you end up losing the ability to earn that growth. So it's not in this particular presentation just because it's got a lot
Okay.
of,
But even what you just said, it's helpful because, yeah, sometimes people may need that money beforehand. But yeah, off to Victoria with your question.
Yeah, so that actually kind of answers my question, but it sounds like compared to mutual funds, when you build your own pension plan, um, does that mean she can access $1.3 million in equity or like up to 75% of that? Or that's just like obviously for her, her priority is having as much money as she can to pass on to her loved ones, create generational wealth. But I was just curious because, yeah, the main benefit seems to be that you can actually withdraw without affecting the growth,
Right.
which is really cool. Yeah.
In terms of the value, like this, the red line is more like pretty much kind of the market value of what this looks like if you pass away. But in terms of what she can draw, it's a portion of what she's contributed.
Oh,
So
of
the
what she's
first year,
contributed.
first
50,000.
year, if you put in 50,000, chances are she probably has about 40,000 available that first year. But there's usually like a break-even point around 5 to 7 years is pretty much she can pull out whatever she's put in. So it's
Okay.
not, again, there's different policies where it takes up to 20 years before you kind of get to that break even, but we're able to design a policy where about 5, maybe 7 years, whatever you put in, you can take out, which is great. Because if you did that on the mutual fund side, like you said, right, once you take the money out, it can't grow anymore. So you just down to zero.
Yeah, it
Yeah.
totally stops the process. But I think it for this fictional person's priorities, like she makes enough from her business. She doesn't necessarily need to touch the money in the build your own pension plan, but if she needed to, like she could.
For the pension plan, yes. For the mutual fund, she can touch it, but it just impacts the growth.
It impacts the compounding effect. Okay, that makes sense. Thank you.
And Victoria, just adding to what you're saying, because I think my headspace was where Victoria is as well, but it's just remembering that the goal of this presentation as well, is to do this as a pension plan. So the goal is not to withdraw before you want to retire, right? So just to leave that money grow as well. But you can take away from the life insurance if you want to, but just remembering that the goal is to use it later, right?
This is like maybe part 2, right? I'm like, this could be a part 2 where we can show all the numbers. Yeah, definitely that we can do another presentation about that and how you can use the money and withdraw the money. Something that's like advanced. I'm going to tell them, you know what? You can actually put the money into the life insurance policy first to build your own pension plan, withdraw the money, and then invest it. So you're going to have double dip your money. You're going to do both things. So part 3.
I think you may want a second webinar. There is one more question here on the chat. What is the estimate premium payments difference between a 1.25 million term insurance and a whole life insurance? Let's say the whole life costs 50K in a year. Do you know how much a term insurance would cost?
Off the top of my head, I guess it depends if it's like a 10-year, 20 or 30-year term. My guess is maybe a fifth of the cost, or to maybe like a 10th at the max. So maybe let's say it's 50,000. A term insurance, I'm estimating 5,000 is what you would put in, right? So then I guess some other scenarios you might hear from other people is buy term, invest the difference, right? So if I'm spending $5,000 on a term insurance policy, well, out of that 50,000, only got 45,000 left to invest. So that's actually less money. But the thing is with term insurance, after the 20 or 30 years, that term insurance is going to climb up. It's going to go from 5,000, eventually be over $50,000 per year. And at some point, you're just not going to pay for it anymore because term insurance is really meant for 10, 20, maybe 30 years. After that, it's not really meant to pay a lifetime. And actually at some point, like usually about age 81, term insurance just auto terminates because you're so close to death, right? The insurance company is going to lose money. Whatever you put in, you're going to pass away like very soon. So because term insurance doesn't last forever, at some point, term insurance will be gone. And then now you're just left with the investments. Now you're back to this red line. It's okay. Well, if you pass away, it's just whatever you have available, whatever the market value is. So then you could do term insurance. The cost is lower. It depends what you do with the rest of the money. So again, this could be like another discussion. Like if you don't have $50,000 for a 1.2 million, let's say, you can maybe do 600,000 whole life, and then term the rest to make it a little bit cost effective. If the need is 1.2, and then there's different conversion options you can do, but that again, that gets into a lot more detail in terms of how to structure these policies. But hopefully that answered the question. Roughly about a tenth to maybe a fifth of the cost would be cost of term insurance,
Yeah.
but it won't last. So
it
it's
depends on your goal too, right? So this is like, like Victoria said, you're transferring wealth over through different generations, right? So you're really setting, your loved ones up. Definitely we have kids of our own for the future, because that's the money that's gonna flow out of our corporation.
That's great. Thank you. And on that note, I do want to mention, because I don't have kids, and I told you guys once, like, I don't think life insurance is for me. Like, I don't have kids. And I think your answer was like, do you have a loved one? Because it could be my partner, it could be my sister, it could be my nieces. So it's just thinking about all the taxes that it would need to be paid in case I pass. Like, so I have all that money there that could be used by my family, even if I don't have kids, and then like half of it would go into taxes. So I thought that was a good way to put it as well.
yeah.
For sure. So I think any more questions, Julia, before we move on to
Very good. Good to get-
summarizing the very end?
Okay. So here are about 7 attributes on what an ideal investment should have. On the right-hand side, we're going to compare traditional investing with stocks and mutual funds versus life insurance, right? And build your own pension plan, BYOPP. First one is the ideal investment should have guaranteed predictable values for any given year. Right? With stocks, there's no way to guarantee what the account's going to be worth because it all depends on what the market is doing. Right? So Tia, if I were to ask you, right, can you tell me what your stock portfolio is going to be worth? Let's say 17 years from now?
No, because I don't even know what's going to do tomorrow. It fluctuates so much these days.
Well, with that participating in whole life insurance, there are guarantees. Each year in the actual contract, so the life insurance policy itself, there's a minimum on what the policy is worth. So yes, it is guaranteed on any given year, we can predict what the policy is worth at a minimum. The next attribute is we want an investment with steady growth and minimal volatility. Right? With the stock market, if you look at the past 30 years data, the TSX, or Toronto Stock Exchange, was quite volatile and it had a standard deviation, or what we call fluctuations, about 16%. So lots of up and downs, right? With participating whole life, regardless of which carrier you go to, the standard deviation is very low, about single digits, about under 1.5%. So that means less heart attacks in terms of the dividend growth. For the next attribute, I like this one. Growth is guaranteed to never go down. Right? With traditional investments, it can go up, but like Tia said at the beginning, it can also go down. Right? The reason why we put a question mark here is because technically, if you wanted your money invested in something that's guaranteed to never go down, you'd put into GICs, right, which never goes down. But if you did that, you're not going to get that 6% rate of return you need to be able to build your plan. With BYOPP, it is a dividend-based life insurance policy, so it can never go down. There's actually no such thing as a negative dividend. The worst it can do is a zero dividend, but we work with repo companies that have always paid a dividend every single year without fail. One of the companies we work a lot with has paid a dividend every single year for the past 80 consecutive years. And another insurance company has paid dividends for 175 years. So pretty strong companies, even though they say it's not guaranteed. If you got a track record of paying 80 years without ever missing a year, chances are you're likely going to do well. But again, worst case, maybe zero for that year. But the big thing is it'll never go down because there's no such thing as a negative dividend. Number 4, growth is tax-free. Right? With all stocks and mutual funds portfolios, all the gains get taxed. With BYOPP, all the growth is tax-free. And the death benefit into the corporation is also tax-free as well. The next one is my favorite attribute. Maybe I should put that number 1. Is there a way to take out the equity from my asset without affecting compound growth? With traditional investments, we talked about that earlier with the chart. No, right? Each time you take money out, the money can't grow for you anymore. So if you're earning that 6% return, every draw you need, right, to run your business, you want to buy a vehicle or take the money in advance, right, it's costing you 6% that you could still be making if you were still invested. With participating whole life insurance, if you took the equity out, the policy stays intact and it's going to continue to compound and grow as if you never took money out. Number 6, we'll give you more tax-free dollars upon death. So no traditional investments again. As you mentioned, with each dollar taken out, you're depleting the account. And then whenever you pass away, whatever that's not left over is not what goes to your loved ones, right? Money is going to need to flow out of the company when your corporation winds up, and then that'll get taxed. But with life insurance, the death benefit is 100% tax-free into the company. And then if you remember that drawing, right, majority of the death benefit flows out through the capital dividend account as tax-free dollars to your loved ones. And then for the last attribute, ideally, we want something everyone can qualify for. With investing, yes, right? If you have money, you can invest it. However, with life insurance, as great of an asset as it is based on health. So you have to be healthy to qualify. So unfortunately, not everybody can set up a BYOPP. Right.
So yeah, okay, I think we're done. So there you have it. Thanks for your attention. Hopefully you learned a different option of growing your money securely in your business using life insurance.
Any questions or clarifications before we put up our contact information?
Thank you so much, Darryl and Tia. That was so great. We already had a lot of great questions. We are definitely going to open the floor here. I do have a couple of questions myself. But yes, thank you. We appreciate that. Just a reminder that we will have a draw as well very shortly. So if you can stick around for another, I don't know, 10 minutes, we're going to do a draw. You may win $100, and it's high chances of winning here. So stick around. Anyone has any questions? I think it's okay to put in your contact information, Darryl.
Okay.
And yeah, if anyone wants to, oh, sorry, do you have one more slide to go?
Just yeah, contact information. So business card is on the left and the QR code's on the right. So
yeah, it takes you, the QR code is going to take you to our online availability where you can book a time with us. If that link doesn't work, then you can always just kind of shoot us an email.
Great.
And while you're looking for more questions, I'm just gonna add the participants onto a draw for one of the gift cards.
Amazing.
So flipping around different.
So I have 3 questions, not 1, but 3. So I'm just gonna go ahead. One is, so you gave an example of 50K investment per year. Let's say I were to start investing, putting 25,000 right into my policy, and then I decide to move into 50,000 later on, like 10 years from now, I start making 50,000. How does that impact? Does it change anything? Because as you mentioned, the earlier you start, the better. So your baby is starting at age 0, for example. So if I start today at 25,000 and then in 10 years, I increase to 50,000, does that question even make sense? Like, would that change anything?
Yeah, the 25,000 will have its own trajectory. So this one was 50,000, and then I pull out 100,000 based on somebody age 40, right? So if you had 25,000, then chances are, if you're the same age, I think you're a lot younger than us, but if you were the same age and you did that, you get roughly about half in terms of what you want. But we can actually structure the policy where we can get you approved now, and then 10 years later, if you think you get a capacity to get to that 50,000 range, we can structure in a way where you can actually get approved without going through medicals again. The only difference is that 25,000 will kind of have its own model. And then when you want to do another 25,000 later on, that'll be based on maybe your age at that time, but not your health. Your age and pricing at that time, but not your health, because we can actually get you pre-approved at the beginning for a global amount by structuring it differently and be able to do some conversions.
All right, that answers. Thank you. The other question is, do you recommend having, for a pension plan as a goal, do you recommend building mostly out of life insurance, or do you recommend a mix of life insurance and other investment products? And even the double dipping that you mentioned here, that was a good example.
Yeah, for sure. Like, just because, we are incorporated and we want to flow as much tax-free dollars out of our corporation, we would definitely recommend the life insurance policy part, the BYOPP. And like I said earlier, why limit yourself to one? Why not do both? Right. So that would be like a part 2 of our webinar on how to kind of withdraw the money out and able to do other things with it. Right. So one of the example is investment. And that's exactly what we are doing with our policies in our corporation. We are portfolio managers. We know the market is hopefully on the uprise. Right. So what we did was we took out we withdrew all the cash values from the life insurance policies and we put it into the stock market, right?
Yeah.
So
It's
now
not a clear trend yet, but we've got time on our hands, so we did that. For somebody that's maybe risk adverse and they don't want the money to go down, like right now with inflation data, high interest rates, what's going on around the world, it's not clear that it's uptrend yet. So then having this BOIOPP insurance policy is a good way to kind of house your money in the meantime. If the market was just straight upwards and everything is good, we'd find a way to do a blend. Maybe put some of it in insurance, put some of it in investing. But right now it's looking at what's a safe place to park your funds, but still have it accessible. Yeah.
Perfect.
it all comes down to it depends. I don't because it really depends on your situation, right? It depends on your family situation. It depends on your goals, and that's when it's a good opportunity to meet one-on-one to find out why are you saving all this money for? What do you need? What does retirement look like for you, right? Because everybody's retirement may look different, right? Some people want to travel, some people want to live simply and not travel. So of course that is going to change kind of our plan for you and what we want to invest in your corporation.
Perfect. And I have one last question, and then I see Victoria has her hands raised. So my last question is, you mentioned in the beginning you have 17 policies right now for life insurance. What does that mean? It's like when I mentioned like 25,000 and then you add another 25,000, is that what it means?
Yeah. So when we take that,
yeah. Well, when we first started, right, we bought a policy, and what happens is every year that our business.
Sorry, let me mute. I have the floor. Yeah, sorry about that.
Yeah, no problem. Thanks, Julia. So, our business continued to do well. So what we're like, okay, what do we do now with this extra money? Well, you know what? Let's actually buy another life insurance policy. House the money in there first, right? And when we do need to take it out to invest in another property or to invest in the stock market, at least right now it's growing for us. Right. So that's kind of the reason why we've kind of been laying more policies as the years have gone by, just because we know the power of it. We know the power of that compound growth, especially in the kids. Oh, my goodness. Like the growth for the kids is great. And not this presentation, but we did a presentation earlier on last week about how life insurance actually could be an option instead of RESPs. So people that do have kids that do RSPs, you know what? Again, RSPs will eventually deplete, right, after they finish school. But with the life insurance policies, they can still withdraw that money to go to school, but it still continues to grow. So there's just so many different things that you can do with the life insurance policies. That's why, like, you know what? Every time we have an extra bonus, business as well, where do we park it? Let's just buy another policies first, since we're still young. Actually, this next set of policies, if we ever do it more, I don't know. If there's many questions, I had a pinched nerve. And I'm just getting older. There's more yeses when I have to answer those health questions. So anything, I think 17 is a good cap for us.
Yeah, because again, financially it's a good decision, but again, everybody has a bit of a threshold, so kind of at a cap on what I want to contribute towards these.
Yeah. Amazing. Thank you so much, Victoria.
Thank you. So just to clarify my first question, so in lieu of a salary last year, you took out life insurance for the amount of that salary? Is that correct?
We have, so very similar. So again, instead of paying ourselves, say $200,000 because we have this property and the cash proceeds, we technically don't need to pay ourselves $200,000 for at least a couple of years. So we can just this cash, which is an option. We can invest it, we can dividend. Doesn't really make sense. So we took half, so it's just 50,000 each. So we bought a policy each to get it going. And then each year is a little bit different. So this year we may draw some of it out. Just again, this year for 2023, like we have like a good cash position, but we don't want to draw $0 because we want to at least throttle out that money purposely. So we might do just maybe 60,000 a year is all we really need for this year, just to kind of minimize our tax bracket. But there's no point in paying $0. It's just last year we had this huge capital gains that was our major source of taxable income.
Yeah. Okay, that makes sense. So especially with last year, you had those capital gains come in. Therefore, oh, my computer's going to die. Sorry. Therefore, it felt comfortable to dedicate what would otherwise maybe be allocated for a salary.
And there's a bit of planning as well too, because then even though we don't pay ourselves a 200, like we wouldn't do 200,000 per year into more insurance policies because that might be a little bit too aggressive. Because like I said, this year there's no capital gains, so we want to safely draw some of that money out and control our taxes. So lots of spreadsheets, lots of numbers to kind of think about. Yeah.
That's cool. No, I'm really interested. And then my second question was mainly if you had a client case study that you could share. I know you've tested it on yourselves and you guys are a great case study for the success of it. I would love to hear if you've been able to successfully suggest this to clients and what their results have been.
Yeah. Oh, yeah, absolutely. Actually, we have numbers of business owners, from dentists to massage therapists to physiotherapists.
Doyle.
Yeah.
That's definitely
Like we need to do that because
gonna put someone on mute
Okay,
there.
thanks.
Yeah, definitely. You can book a time one-on-one with us, and we can share with you not the clients, but not their names, but different scenarios where this would make sense. Yeah.
Amazing. Any other questions? I think we can maybe get started with the draw, see who is the lucky winner. And definitely Tia and Darryl, if you guys are up for it, a number 2 webinar would be amazing too, because it's so interesting. I definitely never understood the life insurance as an investment before until I heard you guys talking about. And this is so helpful. And it's so clear, like that drawing that you have in a box, it's like, it's just so clear. Thank you.
Great, thanks for that feedback. So let me stop sharing. I'm just going to share my Safari window.
Yeah, let's have some fun.
Yes.
We've done this before, and it's always really fun. I don't know what it is. It's something about
I
wheel.
would say this is the highest return. It's like you sign up for a free webinar, you have 13-in-1 chances to win.
So this one is
This
for...
first one is actually a $50 Amazon gift card for all those that registered. So there are some people that registered, but they couldn't attend.
Okay.
Just thank them for registering, and then they're going to get the link for the replay. So I'm just going to shuffle it and spin the wheel and see how it goes.
Perfect.
See who it is.
And it is Rob.
So congratulations, Rob. I don't know if you are on this call, but I'll circle back with you, Julia, to see which Rob that is, and then we'll send. Okay, and this next tab is just make sure I got everybody's name. So I think there was 15 attendees still on, so it should be 13 minus me and Julia. 1, 2, 3, 4, 5, 6, 7.
That's right.
13.
Anybody's name we're missing before we do the draw? Okay, so this is for $100 for a restaurant of your choice. Since this is a lunch and learn, we can't be there in person, but definitely enjoy a lunch on us.
Drum roll.
Yes, we get a pen.
Thank you guys for doing this. This is exciting.
Carolina. Congratulations, Carolina.
Yep, I think we might have the contact information now. Let me just double check. I don't want to lose her before.
Carolina, are you there?
Yes, she said thank you on the chat.
Awesome.
Okay,
Great.
awesome. I think we do have your email, so we'll reach out to you to see where you want your restaurant gift card, and we'll be happy to send that out then.
So thank you very much, everyone, for attending our seminar. Thank you so much, Julia, for putting this together. You're so awesome.
Thank you, guys.
Yeah, hopefully everybody got, a few tidbits. Any questions, any other scenarios you want to run, by all means, give us an email or a text, and we'll connect.
Sounds good. Thank you so much.
Enjoy
Have
the
a
rest of
good
your
rest of your
day.
day.
All right. Bye, everyone.
Bye.
Thanks, bye.